Hey everybody, welcome back to the Economic Analyst channel. I'm sorry for the belated video on this, but I wanted to take this time to go over the Consumer Price Index report that came out a week before last and do a little bit of an analysis on this and give you kind of a forward guidance and projection of what that means for inflation going on into 2022. I'm going to be releasing a couple more videos on this in the next couple of days. The one after this will obviously be the Producer Price Index report, and then the next one is going to be a trend analysis based off of the confidence in the U.S. dollar, what's going on, and where I think inflation might go from there. And then there's going to be another video that I'm going to produce that's going to follow up on that, and it's going to talk about the past trends that we've observed in changes in confidence in the dollar. Because it's going to be those changes in the confidence of our currency that is going to be a driving force for inflation going forward, okay? So the CPI numbers came out at 0.5% for this month, and that's an annualized rate of 7%. And long story short on this, what this means is that we've been brought in line right now when we take a look at the year-over-year inflation numbers of 7.1%, and when we compare that to money and debt, what it means is that we've been brought in line with this 70% confidence interval, which is a high confidence in the U.S. dollars. That's where I'm kind of going with this. Now, pay no attention to this 40% number. This is a number that I'm figuring out for 2021 to 2022, and I'm going to create a video talking about that. But right now, the overall confidence in our currency is really about 70%. So when we take a look at what's been going on in the 2020s, right quick, and we do the figures based off of that, we're at a 70% confidence interval. This 70% confidence interval means that we've kind of reached that threshold of the consumer price inflation where it is now do or die. One of two things is going to happen. Either A, we are going to stay around this confidence interval, okay? And if that's true, then based off of money and debt entering the system, if the Federal Reserve continues its existing monetary policies, if our government continues its existing fiscal policies, and if banks continue lending out at the rate that they have been lending out since the early 2020s, then the average annual inflation rate is going to kind of hover around 4.2%. Okay, so it's going to be like that. Doesn't mean it'll be like that every year. It means it'll be this year, in and out, okay? Now, if that doesn't transpire, and if we start to see a failing in confidence of the U.S. currency, then what it will mean is that the average annual inflation rate will reach 9% for this year. If we start to see a huge shake in the U.S. dollar, and I do think that there's a possibility that that may happen. I'm going to create a video on to why. Then we may be seeing something that's more akin to the 1980s, where we might see a run-up in inflation in the early parts of 2020s before it kind of stabilizes and gradually falls down in the latter parts of the 2020s. So we might be seeing a repeat of the early 1980s, give or take on that. And I'm kind of developing and thinking that out. But essentially right now, long story short, we've reached that threshold here where we're in the green on the Consumer Price Index. So consumer prices have caught up to monetary and fiscal policy, where there's usually a divide between the two. There's usually a lag between monetary policy and fiscal policy and consumer prices. We've now caught up to that. Now the question is consumer prices going to overrun monetary policy, so to say? It means it's going to go higher than what monetary policy should suggest it with a strong confidence in the dollar, or is it going to stay where it is? Okay. And that's something that I'm definitely going to produce in the next couple of videos and give you both stories, both sides of the equation, and what's going to happen to transpire on that. So looking at the prediction model that I created for consumer prices, the 1 month forward looking guidance here, I predicted that the inflation rate would be 0.7%. We only got 0.5. And so that created an error of about 0.2 to 0.3. This says 0.3 because this 0.7% was actually close to 0.75, and we really got only 0.47. So rounded, that's 0.3% error, okay? I want to take a couple of minutes and talk about where the model was a little off on, okay? One of the things that kind of threw the model off was energy prices. So energy prices comprise now, as far as a weighted index, of 7.5% of the consumer price weighted basket, okay? So when energy prices drop by 0.4%, if you take 7% of that, 7.5% of that, that's a 0.03% differential. Now, that may not seem like a lot, right? That may not seem like a lot, but there are other factors that can play into this. One of them is transportation services. And so those transportation services comprise another 5%. They fell by 0.3%. So that's another 0.02%. You add those together, it's 0.05. So that explains where, a fifth or a quarter of the change was thrown off on the model. The big component, though, is the shelter component index. So the shelter component of this consumer price index has been heavily lagging consumer price inflation going into 2020 and 2021. When we take a look at the shelter component, which is highlighted here in red, take a look at the year-over-year CPI. It's risen to about 7.1%. All right, that's the highest annual inflation rate that we have seen since 1982. And with that, though, the shelter component, which in historical times past was corresponding very, very strongly with the consumer price index, has sort of lagged very much so in the early parts of 2021 and 2022, okay? Now, in the 2010s, ironically, it's been the shelter component that's been dragging price inflation up as the Federal Reserve's monetary policy sort of reinflated the housing bubble that was going on in the mid-2000s. When the housing bubble popped, shelter prices fell, so did rent prices. Now they've rebounded. Well, when COVID hit and there were forced government shutdowns, and then there were forbearances on mortgages, and the federal government basically waived consumers for having to make mortgage payments or make rent payments or provide relief there, it's sort of driven that shelter component of inflation down, which made the consumer price inflation artificially low in the early parts of 20 and 2021. But now we see this sharp V-shaped recovery, not in the good way though, V-shaped recovery of shelter inflation as inflation is coming back with a vengeance here. And it's been driven by this third component of the CPI, but yet, look at the year over year, it's 4.2%. That's way lower than the average annual inflation of 7.1. So that 3% differential annual inflation, right? In that 3% can manage up and comprise up to a 1% throw off on an annualized basis on the consumer price index. So what's going on the month? Well, for the month, shelter components were up 0.4, but when you have a prediction of 0.7, you're expecting that everything will go up about 0.7. Well, that throws it off by 0.3, and then you take a third of that, and it's really a 0.1%. So 0.15 of the 0.3%, half of this variance thrown off here on the model is basically explained by lower energy prices, transportation and hospitality services taking the hit from COVID, and then the shelter components in initial lag. Now, going forward, what does that mean for inflation? Does that mean that inflation will calm down as these components drag it down? Well, no, on the contrary, I don't think so. First off, with the shelter component, based off my own calculations off the history of the Case-Shiller housing inflation index numbers, which now have peaked at 20% in August of 2021, we're really looking at this shelter inflation popping off at about 6.4% annualized rate sometime next year. Early next year, I've got it as a guesstimate at February of 2023. So what we're going to see, if I'm correct on this, is that the shelter component is going to continue to rise. It's going to continue to push up, and it's going to continue to push up by another 2% annualized rate increase from where it is now. And then that's going to result in, say, a 0.6%, 0.7% annualized permanent increase on the consumer price inflation numbers, okay? And as for energy prices, I created a table a while back that does pretty good at predicting gas prices. And based off of the crude oil price that's going into January of 2022 right now, crude oil prices are sitting at about $85 a barrel. Okay? So it's about $85 a barrel. So if we take a look at this $85 and then compare it to what the producer price index is looking to be somewhere around at the end of January 30-31, we're looking at gas prices hovering around on the average for the nation at about $3.44. At the end of December 31, it was $3.33, which is going to result in a 3% increase, okay? I get these numbers based off of EIA.gov, so this gives you your energy prices, and it's a good historical table for looking at what your gas prices are. Anyway, when we take a look at the consumer price index, we go to the energy sector, we can't use gasoline as the proxy for all energy prices, okay? There's other things like energy services and utilities that factor into this, but when we take a look at the relationship between gasoline prices and the overall energy index, it looks like gasoline prices overcompensate for energy, so a 3% in gasoline is probably going to result in a 2% monthly jump next month, assuming that this crude oil index stays where it is for next year, for the next month going into 2021, okay, or 2022. So with this 2% jump, right, this 2% jump right quick is going to translate into 7.5% of the consumer price index report. So that means it's going to be about a 0.15% jump versus a negative 0.03% drop that we saw this month. And that's probably going to make the consumer price index numbers push up again for next month. And therefore, if that holds true, we're probably going to be looking at a higher annualized inflation rate, probably around 7.5% when we get January's numbers coming out at the end of the month. Now, next video that I'm going to make on this, which will probably come out tomorrow or Tuesday, I'm going to go over the producer price index report. There's a lot of information to go out on there, some very interesting trends going on there. Long story short, and I'll go into more details on this, based off of consumer prices and the final demand numbers, we're probably looking at another 0.4% jump in consumer price inflation numbers for January 2022. And, it could go a little bit higher or a little bit lower. In this case, it surprised me that it went a little bit lower than what I was predicting. But I still think it might go a little bit higher than that 0.4% next month. And I'll go into why in the next video. So guys, that's all that I have for this one. If you have any questions, just make sure you drop a comment. Let me know what you think about all this. I appreciate to hear your thoughts and learn from you for a change, as you learn from me as we try to exchange information and get a better grasp of what's going on in our economy and our society right now in the U.S. If you like the video, if you like the content that I produce, make sure you just click that like button to show me some support. Subscribe to my channel if you haven't already. If you want to continue to receive valuable information, or what I think is valuable information for you to receive on the current state of affairs in markets and the economy. And click that notification bell. You'll always be notified when I upload a new video. And again, guys, I'm sorry that it's been a while since I produced my last video. It's been over a week, but I'll be pumping out the next few as we start to play catch up with what's been going on in the markets and get ahead of what this tailspin has been going on in the latest trends that we've been seeing in our economy. So once again, guys, thank you for watching this video, and I'll talk to you next time.